constantly discussing the economies of Nigeria, Ghana, Cote d'Ivoire, but we seldom look at the prospects that exist in lesser known economies, the frontier markets, particularly of West Africa. Ronak Gopaldas is a country risk analyst at Ram Merchant Bank, and he's here to tell us more. Okay, huge semantic issues here. We'd love to use the blanket definition, emerging market, but an emerging market is a little bit better than a developing economy. Then there are the frontier markets. What does that mean?
When people talk about frontier economies, essentially what they're talking about are the little guys in the emerging market space. So basically these economies would exhibit the same long-term growth potential, same attractive features as your emerging markets, except the difference is that they'd be at a much lower level of development.
Right.
So it's kind of seen as the new wave of emerging markets, but essentially virgin territory at this stage.
Virgin territory, high growth rates because they're coming off a low base, usually very limited infrastructure, and those are the pros and the cons. As you see phenomenal growth and opportunity, but you're also still dealing with people coming out of poverty, so very weak purchasing power at a consumer level and almost non-existent infrastructure. Should investors be going there?
When you analyze these countries, there's high risk, but there's also high reward. So as you rightly point out, there are a number of challenges, developmental, based on chronic poverty, high unemployment, huge youthful populations. Also, the institutional frameworks are very, very weak. You don't really have a civil society, a judicial system of any note. But that said, it's a post-war economy and it's recovering. There's a strong need for infrastructure development, and notably in this region, you're seeing a very strong resource boom, and that's the story there. It's a commodity play.
So within West Africa, which countries would you define as frontier markets? Let's start with those within Francophone Africa and the CFA zone.
Well, within Francophone Africa, you've got your gold producers, the likes of Mali and Burkina Faso. But I think the more interesting ones are the post-Civil War economies, Liberia and Sierra Leone, which do not fall under the West African Economic Monetary Union.
Yeah.
They're kind of more part of the collective West African Monetary Zone, which has plans over the longer term to kind of come up with a common currency. But the interesting things about Liberia and Sierra Leone is that there is a huge scope for iron ore and oil potential, and there's a huge spate of investors investing in the mining arena, and the long-term prospects for that are significant. We've seen Vedanta, the Indian company, make its first foray out of India. BHP Billiton and ArcelorMittal are heavily invested in Liberia, and the Chinese, to fuel their ever-increasing industrial growth demands, are in Sierra Leone.
When you look at the two economies, both are coming out of civil war. Their civil wars are historically interlinked, but they've seemed to have coped differently. Sierra Leone is on a steady growth path. We're expecting growth at 6% next year, 5.1% this year, and still experts believe it's an underperformer. You've got a bloated civil service in Sierra Leone as the government embarks on a major macroeconomic reform program. How would somebody navigate an economy like Sierra Leone?
These economies are never going to be easy, and they've got huge structural failings, and that's the legacy of the Civil War. What will be of significant importance to investors is all the ancillary industries that they're able to navigate through. So with the huge iron ore developments, the oil developments, and the commodities booms, that leaves a lot of scope for infrastructure, for agriculture, to develop the networks, the ports, upskill the people, so that the true effects of this windfall filter through to the economy at large.
Liberia is a different kind of a country. There we are seeing real growth, somewhere in the region of 5%. We know they're an exporter of timber, rubber. They've been really caught up in that whole conflict diamond situation. But incredible poverty and a government that doesn't seem to have a grip on all the political forces that are in the country. It's a very complex political environment, I think, Liberia. And the infrastructure is almost completely decimated from their civil war. So what are the opportunities that exist there in Liberia?
You're quite correct. The political structure in Liberia is difficult. Corruption is a major problem there. Ellen Johnson Sirleaf was forced to fire her entire cabinet because it was so bad. But again, the difficult thing about these economies is that primarily at this stage, apart from the resource boom and the commodity play, there is not much else that investors are looking to invest in. Just primarily because the skills are extremely low, and also there's no kind of real regulatory framework to wrap your head around. The institutions are weak, and that makes long-term investing very uncertain.
Yeah, okay, so structurally these are weak economies. Let's move into the Francophone member states. And here we've got a situation where the CFA franc is pegged to the euro because France has guaranteed some of the major loans that these countries have gotten themselves extended towards. How vulnerable are they to events in Europe, for instance, the sovereign debt crises unfolding, the volatility of the Europe, because they do have a currency peg there?
In terms of the currency peg, what we need to bear in mind is that whilst there are some distortions and the success or failure of West African monetary policy is largely dependent on the European story, on balance, the CFA peg is definitely a ratings positive for these countries because it ensures monetary and exchange rate stability. You're not prone to the wild swings you see in many of the other African countries, such as Angola. And also the guaranteed, the convertibility of the CFA franc is guaranteed. So that's in itself is a major ratings positive, and the countries that are rated by the ratings agencies are definitely given a few bonus points in that
And in
regard.
terms of the commodities play that we see within these Francophone countries, you mentioned Mali and Burkina Faso, and we know that Mali is rated as probably the fourth country by way of gold reserves in Africa. He has huge potential, untapped potential, and doesn't seem to have had wild political swings. Burkina Faso, on the other hand, I'm not quite sure what they have to offer. I think it's an iron ore story there as well. Just give us a sense of the opportunities that exist in those countries.
Very much so. You're correct. It's a commodity play again. Gold is the dominant feature in both Mali and Burkina Faso. We are seeing a huge appetite for investment in those markets, especially given the fact that the likes of Australia, which is your traditional source of gold, is now looking to impose a 30% tax on their mines. South Africa, labor costs are, on a comparative scale, very expensive. So this remains an opportunity where production is expected to increase significantly by 2015, and the Côte d'Ivoire as well is another region which is expected to fulfill its potential in the gold producing regard.
And a final question, I know that we're looking at the frontier markets, but to a large extent somebody would say you cannot discount the interdependence of these economies. For instance, the port of Abidjan being the largest port in West Africa means that how you get goods to market, you're going to have to be working with the people in Côte d'Ivoire. There's talk of a gas pipeline between Nigeria and Ghana. If you're tapping into oil in frontier markets like Sierra Leone, they're going to need to use some of that infrastructure. So how interrelated are they, and how does the rise or the fall of the frontier markets impact on the more traditional markets of West Africa like Nigeria, Ghana and Côte d'Ivoire?
When looking at West Africa, you need to kind of view it through the lens of ECOWAS, the economic community of the West African states. And let's bear in mind the long-term plan here, where the long-term plan is for the kind of Anglophone nations in the West African monetary zone to issue a common eco currency. Thereafter, that will integrate with the CFA franc, and you'll have a kind of regional economic hub where you've got bigger markets, job and labor flexibility.
Right.
So the difficulty with that is that it needs to be underpinned by a strong economy, and there's a lot of divergence within the West African countries. The macroeconomic side, a lot of the countries have fiscal deficits which are very high. They've got chronic poverty, weak currencies. So the interdependence is there is a huge scope on the upside to create that common market. But looking at the failings in the Eurozone, where they put the cart before the horse, that's really going to be quite a long-term project. Right.